Hi, I'm Dave Corsi. I'm the Vice President of the Metropolitan Real Estate and Investors Association. We have been around since 1982 and are New Jersey's oldest real estate investment group designed for the small individual investor. I'd like to talk to you. It's January 2019 right now, and I'd like to discuss with you what the market's going to be doing in the next few years. If you haven't noticed, the real estate market has started to soften. You're starting to see interest rates rise, and ultimately that means it's more expensive for somebody to buy a house. Therefore, prices will either start flattening, even maybe come down a bit, and a lot of it again is the job market. Right now the job market is strong, so that will have some effect as well. That'll keep prices pretty solid. But it all comes down to the most basic economic premise of all, which is supply and demand. And the supply in New Jersey, contrary to what you're hearing, inventory levels have been rising. And they have throughout not most, but a lot of the country as well. And that being the case, that is the time for investors to really start looking to make offers, buying property. Warren Buffett talks about it in the stock market all the time. The time to buy is when everybody else is selling. It's a contrarian view, but it's the proper view. When stock market prices are zooming up and down, then you're speculating. We're talking about a real business path where we're talking about investing. So the market right now is going to get flatter than it was, but for an investor, many times that can be a good thing. Because when you see prices going up 15-20% a year, rest assured that means in a little while after, prices will start falling. Because historically, prices cannot rise in 10 to 15 to 20% a year, while real wages are only going up 1 or 2%. It's basic math, folks. So please keep that in mind. The other thing will be, quite frankly, in New Jersey, there's a lot of McMansions, and that market is softening rapidly. Why? People are having less children. So they're suddenly saying, why would I want a 5 or 6 bedroom house? And a lot of people are gravitating back again towards the suburbs that are close to the big cities, particularly that have train access to places like New York or Philadelphia. So that's benefit. But again, those big McMansions are going to be taking a hit. There's gentrification happening throughout. I've always said the key to the market is young people, first-time home buyers. And there's a lot of evidence that they're not that ready to start buying houses. And that will soften because the person who's looking to sell to that first-time home buyer, if they can't get their house sold to move up to their next level, and a person who's looking to sell their house above them who might be looking to retire to North Carolina, that slows down the market for everyone. So these are the little signs that you should be looking for. And quite frankly, you're always looking for what the mortgage market is doing. And will there be a next flood of foreclosures? I personally think you're going to see an increase in the foreclosure market because there are loans being made right now that, quite frankly, should have never been made. Kind of reminiscent of 2008. Mortgage rates are going to be rising a bit. Nobody knows exactly how much. Ultimately, interest rates have to rise. It's a whole thing of economics and finance that we don't want to get into right now. But sooner or later, there has to be an increase in the mortgage rate. And always remember, a lot of people forget about this. When you're borrowing, you love low interest rates. But if you're at a point where you're not a borrower anymore, you're a saver, which are generally our older folks, they're not necessarily looking for that low interest rate. They want a higher one because if they're going to park their money in the bank and live off their interest, they're not going to be doing much living if the interest rate is 1% or less. They would like it to be, where a bank was paying them 5% like it did in the old days. So you've got to remember, different people have different points that they're looking for. So that will always have an impact, and politicians, being what they are trying to balance the two. Interest rates right now, January 2019, are still historically very low. So with that in mind, I could not stress enough, do not take out adjustable rate mortgages. Take out a fixed rate 30-year loan. I remember 10, 12 years ago, people were telling me they had the opportunity to either take out a fixed rate, let's say at 6%, or they could get a teaser rate at 1.99 for 2 or 3 years. What should I do? I always advise them to take out the fixed rate mortgage because then you were not going to have any surprise. Remember, if you took out that teaser rate and then suddenly your payment went from based on 2.99% to 6%, your principal and interest payment, well actually your interest payment of that loan doubles. So if you were paying $1,000, you may suddenly go from $1,000 up to $1,700 a month payment. That's one of the big factors that made the real estate crash of 2008 happen. Be conservative with that. Also, take out the longest term mortgage you can. Don't take out the 15 years as an investor, take out the 30, even as a homeowner. Why? Because you can easily turn a 30-year into a 15-year just by increasing your payment. It's very simple. There are amortization schedules all over the internet. You could easily, within a minute, see how much you would have to increase it. The reason being is, let's say you hit a little rough stretch there. You can then simply revert. You'll still be making that lower payment. Even if you were making, let's say your mortgage payment was $1,500 a month and you were making $2,000 a month payments to pay it off quicker, suddenly you hit a little stretch where then you could go back down to $1,500, which you might still be able to afford, whereas if you were stuck with a $2,000 a month payment, you might get yourself in trouble. If you're afraid of the real estate crash coming, we don't know if it's going to be a soft landing, if it's going to be hard. Congress will be involved, so quite frankly, I'm sure they'll mess it up. Don't be afraid to step in, but step in slowly. Look at your market values. Always have a backup plan. For instance, whenever we buy a property, even if our initial objective was to buy, fix, and flip and sell it quickly, I always want to have that backup plan that if I see the market has changed and I can't do that, okay, maybe I could rent it for a while. Maybe I could rent with the option to buy it. Maybe I could do some kind of equity participation deal. Always have a backup plan that you'll be able to cover yourself. So if the times get soft, you're okay. And then when it improves, you can then take advantage of an improving real estate market. I want to thank you guys for watching. We hope you've learned something. And if you want to learn more, you can visit us on our website at www.mreia.com. And if you're in the New Jersey area, you can attend one of our monthly real estate meetups where we get more in depth about the topics you need to become a successful investor. If you have any questions about what we discussed in this video, please leave a comment below and subscribe so you can stay up to date on the latest MREIA videos. Thank you.